Good evening, everyone. Welcome to our first quarter market outlook for 2025. Happy New Year. Happy Chinese New Year. 恭喜发财. Hope that everyone has done well last year, and this year we shall do better. And we have a lot more coming in this year for all of us. Uh, Peter, mind if I share a quick slide, then I'll
Oh,
actually hand it
yes,
back to you.
yes,
Yep,
yes.
thank you. So before I hand the floor to Peter, I will we have two speakers tonight. One is our head of research, Peter Kong. He have actually really in-depth experience in research. He has been through the bond market and has been in the foreign house for quite a while. And that's why now he's joining us. He have added a lot more value to the team, where he has actually gave us a lot more depth to the market of how we can see things in terms of flow and also the angle of the narrative for certain stock ideas. So I'm definitely really excited and happy that we have Peter with us tonight. And the tail end, we have another bonus session will be with Isabelle. Isabel will share with everyone on how you can make your money work harder through the power of leverage. And yes, that is Warrants. And myself, I'm Adrian uh, in the marketing team, but I do host a weekly session too. Yep. So without further ado, I shall do a bit of a quick intro on disclaimer. For those that have just joined, that have never joined our session, you can print this out and hang it on your wall in your toilet in front of a mirror and read it. Yep. Secondly is here at Kenanga, we are addicted to winning awards, and because why? That is because we are just wow, really competitive and want to be the best for you guys. And yes, the next one will be KDI Go, something that is creeping around town that we are really excited to share. You can actually scan the QR. I use KDI Save 4% effective annual rate, and yes, there's KDI Invest. There's no complicated projection and just pure rewards. And $8 if you sign up now. So a quote for the day: an investment in knowledge pays the best interest. And to that, thank you everyone for joining tonight. And I shall pass the floor to Peter to share us the market outlook. Oh, just a quick one. By the end of it, hopefully, you can help us to fill in the feedback form so that we can actually do better. And yeah, the floor to you, Peter.
Sure. Thank you, Adrian. Just give me one moment as I share my screen. Yeah. Do you see my screen right now, Adrian?
Yep.
Right. Yes. In that case, I will have the pleasure of spending the next close to 1 hour of speaking to all on the call. And I must say that this is the second time Adrian has invited me to this call. So the first time around, I must have done relatively well to earn another call back. I think some.
Fantastically well.
Well, thank you for that, Adrian. Compared to the first time that I did this call a quarter ago, some of our calls have really done quite well. Some of them not so. We will go through and take a quick look and take stock of where we are at. And of course, before that, I will go through how we see the entire market before we jump into specific, I would call it hot sectors or trending sectors. Obviously, no one really has got a crystal ball on what Trump is going to do at this moment. What we can give in terms of the strategies that we are built on, I hope this will be very useful for all of us on the call. And before I start, I'd just like to also wish everyone a happy new year from the Kenanga research team. Over the past 2 weeks, we have been speaking to investors on the institutional side, and the truth is, a lot of them came back from their December holidays, starting to deploy some monies, right? Because those who follow the stock market know that last year was a relatively good year for Malaysia, even within the region. So some of the fund managers, when they had come back and they started to deploy, they start to reduce their cash holdings. Some, as I understand, even to 6 or 7% of their portfolio. So people have started to deploy monies again. However, the market is always quite unpredictable, I would say. And even this first of 2 weeks of the year, we already see so many statements that seem sometimes at odds with each other, especially coming out from the US. On the one hand, those who follow the US news would have seen that there were reports that Trump could curtail some of its tariffs so that it only targets specific sectors, only to be quickly reverse tracked, right? Or Trump came out to deny that. So that causes a lot of volatility, and that in the midst of that, that has also caused the market to guess that Trump may really be serious about putting in these tariffs. So as that expectation increased, we saw in US that the inflation expectations start to creep up again. That led to a few signals. For example, those who follow the US market in terms of the looking at the bond yields will know that the bond yields have crept up again. On top of that, we have also seen, for example, in the US, there seems to be even whilst the whole world was looking at what Trump will do, little did we know that out of the blue, the outgoing president, Biden, last Thursday, came out with a surprise Bloomberg present, outgoing present, to say that they might levy some AI chips related export bans or quota, which was heavily condemned by the entire tech industry. So we can see things are very tumultuous right now. Definitely, what we are saying is this is not something that is unexpected. In fact, as we laid out our strategy, we want to think about it as this is a replay of 2018, but definitely not a repeat. This is how we would categorize it. And I think best place to start off today's talk is perhaps to look back at 2018 to get some lessons of what we had learned previously. Now, those who remember 2018, when we look at the entire market, the first thing that we recall is the trade war. Who doesn't, right? But when we look at the trade war at the time when the tariffs were first put in, that was in July 2018. But in truth, the threat of the tariffs had already started in around March 2018. At the time, once the tariffs were sort of hinted, it was later implemented in quick succession, and we saw both sides sort of engage in a tit for tat type of trade war where billions and billions of goods started to come under a tariff, which means that within a period of 2 years, in between July 2018 up to somewhere in 2020, there was a lot of uncertainty. What happened to the markets back then perhaps is a good place for us to begin our discussion. Of course, the top chart, the one that is the only graph that is moving upwards, that was the US, and we based it based on March 2018 as an index of 100, meaning to say that that shows you the returns over a 2-year period. I selected the period up to January 2020 because that was probably one of the areas where the market or the economies could heave a final sigh of relief after the Chinese and also the US came together to look at a trade agreement, right? So I think that was where there was a little bit of calm in the whole picture. In and within that time, if we looked at the various indices over here, the S&P, the MSCI Asia Pacific, and also the MSCI ASEAN. ASEAN was actually a relative underperformer. And this underperformance had lasted at the time in terms of the drawdown, as you can see here, about a 10 to 15% drawdown in the first about 6 months, I would say, before things start to move up again. Using that as a context and a pretext, since elections in November for Trump and the uncertainty that ensues, we think that first quarter 2025 is indeed a little bit more risky, or more risk is skewed slightly to the downside, in that news that come out can be easily interpreted as a risk at this point in time. Those who recall 2018 would also remember that other than the trade tariffs, that at the point in time, US was also going through somewhat of a interest rate, or the Fed funds rate adjustment cycle upwards. So these two conditions are very similar to today. In a way, a replay, as I said. In and around that whole context of trade war between two giants, where does that leave a country like Malaysia? So in and around that time in 2018, we saw obviously there was local politics, but even so, our KLCI impact at the time was a little bit more insulated. We think that at this point in time, when we look at the past 2 months since the Trump has come into the picture, as you can see on my bottom right, which I'm flashing out right now. This chart is probably accurate until maybe a week ago. MSCI ASEAN, uh, without much surprise, is also an underperformer compared to the S&P, and Asia Pacific and ASEAN, as you can see in the red charts here, compared to the previous time in 2018, the first 2 months share price drawdown is not very dissimilar. And again, in those two times, KLCI had been an outperformer. If we were just to take from the point in time that Trump had come in as a president-elect after winning the elections, Malaysia still is a outperformer, notwithstanding the fact that over the past week, we have seen Malaysia underperform because we are more exposed to the AI chips exports play. And I'll explain a little bit more later for those who follow keenly, but is trying to demystify what is happening there. Okay, so that is the backdrop that we will necessarily need to navigate at this point in time. What we are saying is that we did see Malaysia being previously more insulated. However, I think our government has also said that this time around, the countries, the companies operating in other countries, if they were just to come to Malaysia for the purpose of circumventing trade related restrictions, then they are not welcome. So the idea here, I think the bigger picture is, while most countries are more adept or more suited to navigate a Trump 2.0, so to speak, they are also understanding that in this current environment, it is not so easy just to regain FDI, just to attract unscrupulously all the FDI that is out there, because the countries need to be smart and seem or appear to be neutral. So over here, what risks are we looking for? If you can see this chart over here, again, it's my earlier chart up there was was dissecting the relative movement of ASEAN versus Asia Pac, and then versus S&P 500. But this is more of an ASEAN picture. When we look at the ASEAN picture, we do see that when things get a little bit more I would say, improved on the general macro, that's when Malaysia tends to underperform and other countries would then catch up. Meaning to say that for us, we do feel that in a Goldilocks zone where things are not exactly great, things are not exactly very bad as well, Malaysia tends to have that familiarity of having good yields, having a very stable government environment right now in terms of politics, and we do have certain things that are going for us that we believe this will continue to play out in that Malaysia will be insulated. However, when things become very clear, that's when also we don't believe Malaysia tended to outperform when other countries perhaps have more upside potential. Having said all that, let's look at the numbers. I think fundamentally Malaysia continues to be sound. If we look at what we have said about the fact that Trump could put in tariffs, and I think the reality is that the tariffs in themselves, when you compare them to the total import and export figures in US, those who do the numbers will know it's actually very small. It's only about 3% of the total. But the impact of these tariffs itself would cause potentially the pass-through of inflation into the economy, as we did see in the 2018 in the US. For that reason, the expectation as per the futures market currently are seeing that the chances of a Fed rate cut will only likely come in the second half, most likely. And for that, those who follow the Federal Reserve guidance also understand that currently it looks more to be like a 25 bips cut scenario in the US, which is a lesser amount of cuts. Over here in Kenanga, we believe that there is still a chance that the Federal Reserve guidance might be incorrect when it comes to the end of 2025, because we do see that there could be 3 rate cuts. We have this belief because we think that the US economy currently, when we weigh how it looks like in terms of employment versus the fact that um, the tariffs themselves, we believe is not going to be a actual concrete policy, but more of a bargaining tool. That's why we have 3 rate cuts in our assumptions, meaning to say we don't think the inflation, in fact, is going to be so strong, and we think that the market still requires 3 cut at this point. Having said that, we do believe that at the US and how it affects Malaysia, currently in the very near term, those who hold exporter stocks, gloves and exporters, we think in the very immediate term, the forex impact which hurt third quarter results will likely mostly reverse. In Kenanga's view, we think that there is a chance that for the first few months of Trump coming in, the moment he implements these tariffs that to a certain extent or to any extent that he wants to do it, ringgit will likely first depreciate. So those who hold on to exporters and all that, we think that that is still a decent, very near-term play because the ringgit will likely get weaker before it reverses course. We think that at the end of the year, by end of 2025, we should get to about the 4.45% region, which isn't great. I understand. I know there are some brokerage houses out there that are more bullish on the ringgit. At this point in time, we are going in with a little bit more caution. So we are not building out our recommendations based on the ringgit or the strength of the currency. We think fundamentally Malaysia, as we know, we are in a patch whereby the banking loan growth insofar November statistics have come out is about 5.8%. This is still even for a standards of, I would say, foreign fund managers that look at the country. Typically, they would measure the credit growth as a percentage of your GDP. So it is still considered likely to be better than GDP. And in that sense, the country is still experiencing multiplier effect, right? So your credit is still growing faster than your economy, and that's usually a very healthy sign. We think that at this point in time, the best assessment for us is that it can still grow at about 1.25 times GDP in 2025. Now, 1.25 times of GDP, historically, when times were good, it was closer to 1.4 to 1.7. But today, I think 1.25 times is still a very decent environment, considering that there isn't as much of a asset quality issue in the market. Coming back to the case for Malaysia and why we think that in the near term it should do relatively well is because we think that it is not entirely in the crosshairs of the US. We have decent earnings growth versus our neighbors, as you can see in the chart below. That is a chart that shows earnings growth on the on the y-axis, and on the x-axis is actually the valuations. So currently, in terms of earnings, based on Bloomberg, we are still delivering more earnings than Indonesia and also Singapore for 2025, albeit we cannot consider ourselves to be a cheap market as well, but cheaper than Thailand. What's also interesting is that over the past 1, 2 months, I think I've been fielding questions of geopolitics, about what we think about Malaysia being a BRICS alliance country. I would like to share my view that I think a lot of countries try to join BRICS, and each country might have their own agenda. For example, observers might say Iran could join BRICS because they want to circumvent sanctions. That's certainly not the case for Malaysia. And within Malaysia and in ASEAN, I think joining BRICS alliance is actually somewhat of a moot point, because we see alongside Malaysia, Thailand, Vietnam, Indonesia are also within the fold, meaning to say that there is no worse off country over here in ASEAN, and most are trying to protect their economic interest. Of course, those who follow US will also know that currently the whole idea of Trump trying to put on the tariffs is to really fix the underlying issue of trade imbalances. And if the bearish view over here for the ASEAN is more of when these so-called tariffs are starting to become more unilateral, meaning to say that by US alone, they start to impose this on certain countries where they deem fit. And if they come and target ASEAN countries, that could be one of the areas to watch for. And in that scenario, actually, Malaysia is also more insulated. If we look at the trade deficit, meaning to say the difference between the exports and the imports with US, we can see that Malaysia is still behind Thailand and behind Vietnam. So, of course, all of the countries are dwarfed by China, right? In terms of the trade deficit position that US runs with them. So, in that sense, other than earnings, we think that on the trade deficit side, we are also relatively insulated, i.e., they won't come after us, right? So, I think moving into more local developments on the SEZ and how this fits into the entire big picture. Well, I would just like to say that the ASEAN Secretariat had recently, I think in 3 months ago, come out with a new report to say that ASEAN concretely is a beneficiary of trade diversification place. So the whole idea here was that even in the environment where global FDI had been declining, ASEAN was a bright spot where there was growth all around. And I'm happy to show that actually in Malaysia, where we hear so much about data centers, you can see in the chart below on the left, this is and the last column here is half yearly. We do see that the portion which is in red, now that is the one that is information and communication FDI approved. That's mainly where data centers sit. But if you were just to look at the non-data center elements, those are still very strong in my opinion, right? So we still have got a very diversified FDI pool, and as a percentage of FDI being realized on the right, we are currently no worse off ourselves than our neighbors at about 2 to 4% of GDP. Of course, Vietnam is slightly ahead, and the leader here is Singapore. So all in, our macro numbers don't really look that bad. In terms of SEZ, I think if there are more questions, we can go into it. We think that the latest iteration of SEZ does focus on certain things. Number one, there have been 9 zones that have been confirmed, i.e. there is a bigger SEZ that has been ironed out or finalized. That also helps some of the analysts, including myself, look at the, again, a land sort of angle. And these are some of the property players that we follow and the existing projects that they run in and across the SEZ layout. Of course, over here, in terms of those that we follow, the absolute size is IOI at this point, and this is followed by Scientex based on the projects that are available at this juncture for land banking. Moving on as well, we think because land banking is very important, and recently has been all the more because of data centers. If you think about it, each acre of data centers of land is able to fulfill about up to about 2 megawatts of the sorry, each acre is about that is available as land is able to fulfill about 2 megawatts of data center power. Given the fact that our Kenanga has still guided for a few gigawatts of potential a pipeline, that also means that we're still looking at thousands of acres that is required for land. And in that sense, we think that other than the property developers, we also look at land banking by some of the planters. And in that sense, this is a good snapshot if anybody needs a idea how big are the so-called the land area owned by certain plantation groups, especially in Johor, and also we give you the exposure exactly to where we think the current ending SEZ is. So for those reasons, we think if you want to be very specific to Johor, those that you look at is IOI Corp. You look at SD Guthrie, but if you were to be very picky on just taking the SEZ exposure, then that would be Genting Plantations. So those are some of the names to share with those on the call today. Of course, SEZ play, we will come around to that later again when we go through the main selection of our market picks. Of course, before I go into the actual strategy for 2025 first quarter, I think having spoken about US, it would be remiss if I don't talk about China. The whole idea here is, I think, at Kenanga, our position on the whole China and US, we believe the outcome of this would likely again be somewhat of a come to the table sort of play, right? Where both countries, if they really pursue this form of tit for tat, it really doesn't benefit anybody. Short of calling it a lose-lose situation, today China's economy, as we can see from the news flow, still isn't doing so great. For example, just over the last weekend, the central bank again has talked about certain measures, such as not buying any more bonds, in that they don't want to create any more asset bubbles, as every other fund in China is now buying very safe assets. So everyone is buying local bonds, which only Chinese money can buy, right? So there's been a lot of buying up on that. So even the Chinese central bank is being more careful to signal that you don't want overheating in certain asset classes. But it goes to show one thing. It goes to show that the broader market is not okay. In the very near term, there's a lot of concern, right? Of course, but that also sets us up into a market whereby expectation is also very low, in that the volatility could be your friend. What we are saying here is that the China budget deficit, or essentially saying how much the government will spend versus how much they earn, is likely, as reported by news, to be the highest it's going to be in 2025 versus many, many years past years. I could draw this chart back many years, and you will still see that at 4% is actually very high. What this means is that China is sort of indicating that they would really be willing to keep the powder dry to be able to stimulate the economy as they need to. They have already said that they could pursue a very moderately loose monetary policy in terms of their interest rate. But at the same time, I think their willingness and their follow through to be willing to put their money where it's worth would probably allow a certain stimulus to come into the market that could be much better than the two times that they have put it out previously. Recall that somewhere in early of the fourth quarter, the stock market there climbed close to 30% from a low base because of stimulus at that point in time. Now, having known that, what is our playbook over here? Now we are coming to a part where we talk about in Malaysia, how do we position for some of the Malaysian related stocks? I think having said so much about external environment, I've really not told you anything very concrete because to be honest, everyone is waiting for the January 20th to see whether Trump would actually go through with all their what he has threatened to do. Our view is no, but we do not have the crystal ball at this point in time to concretely tell you that. So in the midst of it, what we think is that it doesn't matter that I don't have the crystal ball because the markets will move ahead of that and react according to the threats at this point, right? So we got to, it's very hard to be contrarian at this point because the market will move with whatever information is being fed it. So in that sense, I think it's no real use to be very aggressive for the first quarter positioning. In fact, I would suggest that if I look through all the different sectors over here, from financials to REITs to telcos, and the final is healthcare. Healthcare includes gloves in our Bursa definition. What we are seeing here is actually a PE ratio, right? A price earnings ratio that you must be familiar with. What I have drawn over here, the length of the candle is actually representative of the range that it has traded over the past 3 years. And that range is measured in standard deviation terms, right? So essentially, the longer the candle, the more volatile it has been over the past 3 years. What we are trying to say over here is it makes more sense at this point in time to have more of the portfolio currently with the lesser volatility, meaning the less fluctuating ones, which is the ones towards the left of the graph on this side. And then that is where we will stick to most of our stock recommendations for now. And those on the right, are we saying that we are going to ignore them? Now, not entirely. We think that, as I mentioned, volatility can be used to be our friend, and therefore, as a easier way for everyone in the call to remember, we are going for a barbell sort of philosophy. Now, what does a barbell philosophy mean? Usually, people think about barbell, people think about two sides, and one side is usually something which is less risky, more visible. And on the other side of the barbell, those who go to the gym will know when you put on the plates, that is where you have somewhat of the more volatile sectors where you can take advantage when things swing up and down. So it's more of a tactical, or if you may allow me to use the word trading sort of positions. So that would be how I believe makes most of the sense at this point, where we have one side where that anchors our portfolio portfolio is something solid, and on the other hand, something more volatile. But actually, what I really am trying to get at is not the volatility in itself, but I would rather think about it as sectors that are closer to primary sectors that and they are very close. They are that would be able to respond best to stimulus. So, for example, if because today this China picture is already relatively bleak, if let's say the two countries are willing to come to talk, or for example, China is willing to put in some stimulus, these are the sectors that will probably run the fiercest. So, in our view, as I map it out here, I first show you the so-called volatility of those sectors to prove it to you, and then now I build the strategy on top of that. On the whole, I'll just go through those on the left first. Those which are less volatile, and also for the current season more domestic. We have the broader consumer. We think that at this point there is some margin of safety in the consumer space. I'll go and explain why. We like Mr. DIY, which we have recently upgraded. In terms of utilities, it's the evergreen, dependable sector. We believe Kenanga offers the best risk reward right now, followed by YTL Power. Domestic-oriented banks is still a liquid yield play. For now, we are less aggressive in recommending investors to seek banks with high foreign exposure, because those with high foreign exposure that they may have business in Singapore, in Indonesia, could be exposed to other elements of, for example, trade or export risk, or rate cut risk. So for that, Malaysia is more stable in terms of our OPR. So that is something that we like in terms of earnings visibility. Now, this DC place here, when I created this chart just about 1 week ago, without all the export chips news that you read, would have been solidly placed here. But today, if you ask me, yes, admittedly, I should amend this chart slightly, but I'll go in and explain to you why we put it here, chiefly because we think the market is one that is still liking the visibility given where the DC plays are. On the right, we like PCAM. We like plant, and PCAM is one of the calls that fund managers right now are very interested, but still quite divided, because we think the demand cycle after a 2-year slump is likely to come back. On the planters, we think that over the next 2 quarters, earnings are likely to surprise, given that currently the tightness in the market that caused the power price to be relatively high is still going to be a surprise area. For gloves, I will talk about it separately, but essentially in the market, some brokers are downgrading it, but we still see reason to stay invested. Of course, as with a barbell, anything in the middle, we're not really pushing very hard. Healthcare, telco, plastics, REIT, some of these have overhang. So for the first quarter, like healthcare with the insurance issue, we are not really pushing hard. Telco, ever since U Mobile had a surprise win, we think that it's not clear how U Mobile will be able to work with the current players like CelcomDigi or Maxis. So it is likely to continue to weigh on the sector. We also have a chart here on dividends at a reasonable price. We think currently dividends above 5%, and when we look at yield alone, it's not enough. We want to buy at a cheap, right? Buy at a cheap. So what we do is we look at the PE, and we use that PE and we divide by growth lah. So for example, if my PE is 20, my earnings growth is 20. 20 divided by 20 is 1. So that's how we plot the graph on the x-axis. So obviously, the lower the PEG, technically is better. That means it's cheaper for the same amount of growth lah. So on this chart, that's why we think that those that we like Berjaya Auto offers a relatively good yield right now, and some of the names that we call out is Padini. MBank and Maybank are 2 of our favorite banks, so they also fit the bill at this point in time, being our first quarter picks. Now, on the data center side, I will probably not labor too long, but what we are saying is that why we get our confidence is because from a top-down perspective, as you can see on the top, all the big tech are still increasing capex into 2025. even after 2024 has been a really good year. So that's the main thing. When we look at the plays down here, I think what we are saying is that on the top chart, Malaysia has come up with some reports on the requirements for these data centers. We think that they are not restrictive, but they will completely discourage those who do not comply on even the minimum of standards regarding water and also power usage. But anything to do with big tech, your Google, your Oracles, and all the of the world will likely have no issues meeting the guidelines. So there is no restriction issue. We think currently also that once we look at the evolution of this play, we are seeing the data centers play now moving on from just your consultants, your property, land bank, to somewhat more higher value chain, as I might call it, like a GPU as a service, and also cloud players. So these are some of the names that we have highlighted for those in the cloud service offerings, and these are the names that we have published in the report. Now, I'll just spend 2 minutes on the chips export side. If you have questions, we can take more. But the news have caused a lot of downside risk today. Even I think some of the names like your Signprops, your Marsings of the world, your YTLs of the world have been impacted to some extent because there has been a report last Thursday that say that there could be a reduction in the total addressable market when it comes to the chips that could be that are AI in nature that can operate out of a tier two country like Malaysia. So Malaysia as a tier two country, and 80% of the tier two are in of the countries in the world are in tier two. There is a limit of 50,000 chips, and 50,000 chips is not a lot because a YTL data center, for example, in our estimation, is enough to alone use up all the 50,000 quota, let alone other hyperscalers. So for that reason, we think that the idea here is that the US government is trying to make the chips so low in terms of requirements that it is either to get the companies to get in conformity with their own US standards under this thing called validated end user. So when you become a validated end user, as many of the hyperscalers are, they should have very minimal restriction because they can pierce the 50,000 chips or AI chips within a certain country. We think that at this moment, if there are certain quota that are imposed on countries, there could be three layers of effect. The first one is that if you know that your competitor or another hyperscaler has also got a certain quota left to be put into tier two countries, won't you, in terms of think psychologically want to max out your turf in those countries? So we think that there could even be a rush for construction related plays. Secondly, we think that there could be minimal impact to those who use those chips, especially those like YTL to sell GPU or AI sovereign cloud. Those we think that given their strong partnership with NVIDIA, they should be able to conform with the US standards as well. But we watch more closely. Server manufacturers like Netgate have been hit. Those who follow NationGate, we think at this point in time, if we consider, and I use the word if we consider a certain portion up to 30%, let's say, is meant to of their servers which they manufacture are exposed to China, we think that our target price would likely be around 260, 270 compared to our current 310 target price. And of course, their current understanding is their servers are being sold to Singapore, but the team is still trying to find out where some of these servers eventually end. I think just for the last few minutes I have, these are certain charts. I would say that if there is a positive scenario in the AI play or the data center play, the top is where we name that where we have most upside: Suncon, NationGate, Masing, Intex, and YTL Power for utilities. Those are in these slides, which you can take a relook again. Those on the tick with the tick mark is what we actually like. Um, Of course, right now, in terms of the broader consumer space, as I mentioned, we upgraded Mr. DIY. In terms of autos, we still quite like, and banks we like the more Malaysian centric. The bottom here is the consumer names post the 2022 wage hike. So expect 2024 to continue to benefit the likes of Mr. DIY. This chart just shows electricity, and we don't think that it will be a huge impact to the market. Currently, moving into big picture, in terms of big picture, and I'll probably stop here before I go into specific sectors. Our CI target is still using what we call a top-down approach, in that we use a multiple of 16.5 times on our earnings to get to about 1,008. With this, we had previously trimmed from 1,900 after Trump came in. Since the last time we spoke, the sector changes is that we have been less negative on property. We upgraded to neutral, but at the same time, we lowered telco to neutral. We upgraded planters, and we downgraded REITs after it did well. Our top picks for the sectors are Mbank, Gamuda, Tenaga, IHH, Netgate, YTR Power, and Mr. DIY. For the small caps, we have SolarVest in the RE space that we are very positive on right now. Intex, Carex. Recently, we initiated SET. So SET is Swift Energy Technology. For those who have, it's an ACE market company, and they do solar as well, but their solar is on top of all platforms, because they need to have very strong anti-explosion properties, which allow them to command a very high margin. So that's one name that we like, as well as Swift Haulage, which is the SEZ play, given that goods manufactured out of SEZ can be exported in Malaysia and in Singapore as well. So these are the sectors that, and these are the caps and the names that we like. And I'll just stop there. I'm mindful of time, and I'll pass the time back to Adrian.
Hey, Peter, thanks. Wow, on the dot. I really, really like your presentation on the barbell and also the volatility on how you have shared with us.
Yeah.
So I think we are not foreign to barbell strategy because Isabelle has been
Mm, mm,
lifting bars for a while.
that's really good. Yeah, that's
Yeah,
good.
and at Kenanga, we are all raising the bar for the industry for quite a bit, right?
Mm.
So yep. So I think we have another 45 minutes for our night. And maybe we can take this time and opportunity to actually proceed to Q&A. So for those that have actually have questions for Peter, you can actually type it in the chat box. But let me get the ball rolling because I already got a question from the Q&A and several. Oh my God, my English on my tongue is just tight. I got a few, you see. Take the easy way out. So in our Q&A, there's a question is, what is your thought and the outlook for the renewable energy related sector for Malaysia?
Wow, that's a very excellent question, and I am glad that you asked that.
From Sue, yeah.
From Sue. Actually,
Mm,
the renewable energy sector is one that in the industry itself, those analysts and fund managers would consider to be well guided. So, what we normally say in a well guided sector means that sometimes the companies can deliver earnings, they can deliver to expectations, but you can scratch your head on, because the share price just doesn't really react as much as we thought it would, right?
mm,
The reason is, and I come back to the reason that it could be well guided, in that to be able to get the share price to move more, typically you need to exceed the guidance, right? So there is this phenomenon in the renewable energy space.
mm,
I would probably go into what we like into the renewable energy space with the renewable energy chart. We think that we are at this point in time currently where it is a very exciting phase. And if you looked at our conviction just now, in terms of left to right, the overweight, the first one that we like is actually RE and utilities, tech, and gloves, right? So you can see that I'm really putting my conviction behind in this sector. A few things are happening on the macro, and I'll go to that first, right? So on the macro, Kenanga believes that currently the market for what it is still hasn't have enough of RE programs if we would want to meet our RE commitments.
Mm.
Wow, that's a big statement to say, right?
Yep.
That we don't have enough to meet our commitments. But as much as our analyst, his name is Nigel, and he has he would like us to think is that the current RE capacity is about 12 gigawatt, meaning to say, but the target is 23 gigawatt, right? By 2035. So you're saying in 10 years' time, we need to go from 12 to 23, right? But if we were just to add whatever is of remaining of the current programs from the LSS5, which is the 2 gigawatt, those who are familiar with RE, and then another program called CGPP. The CGPP is the one that you get to negotiate one-to-one, right, with the producer of the power. If you add those up, right now from that 12 gigawatt, you will only get to about 14. So technically, from 14 gigawatt to our aspiration of 23, there's still a 9 gig shortfall. And
Mm.
to get to that 9 gig shortfall, 9 gigawatt, currently it means that the government needs to accelerate the
Expedite.
rollout, expedite, yeah, the rollout by at least 1 gigawatt annually from 2027 onwards. Long story short, it means that in this current environment, we are saying that there could be another 1 or 2 gigawatt that could be rolled out on an annual basis that is above what the companies are currently already guiding on existing programs, right?
Mm.
That we haven't even come to the market, in that we are anticipating that there is a shortfall, and if the government is going to actually achieve what they set out to achieve, we are expecting more programs. That's what we are saying. So in that, what we are thinking is that the market pie, in fact, could be even more than what is currently guided. Number one, and
Mm.
in this environment, we like in a growing pie, then who do you buy? You buy the market leader, right? So that's how
Solavest.
that's how we play this. So we like SolarVest. In fact, if you look at the mechanics of it, currently SolarVest is not even named by the likes of the Edge yet. So the Edge, for example, have named some names. If those who follow the Edge, Samaden Group is part of them, and some of these in the most recent the Edge.
Yep.
But SolarVest, we believe, given that there's still about 450 megawatt in the LSS5 that hasn't been really made known. And if every award is about 100 megawatt, then you can take 450 divided by 100 and say, hey, you have 5 bites of the cherry, but SolarVest could be one of the winners. So if they do win, we think that it's a good environment still. IRR of about of high single digits is not impossible, assuming that currently the solar module per watt is still coming off. So
Mm.
what we are saying is that if you can get your award today and you build it out, your margins are still very good. So for that reason, we like Samaden. We have, SolarVest. And recently we have also initiated on Swift Energy Technology, or SET. This is a stock that we has recently IPO'd, which we think is very different in that it is the only one in ASEAN and 6 in the
Oh.
world that is able to install explosion-proof solar panels. The first time I heard of it, I also was very curious what's the differentiation. But in terms of the margins, it can give about mid-teens margins, whereas your normal solar players in terms of net margin is closer to high single digits. So that's where expertise really do matter, and the field of oil and gas platforms that need to put solar on those platforms because all these big oil and gas companies are going green, is the spending that will fuel the next capex cycle that will benefit SET, and that's one of the names that we initiated with 100% upside.
Amazing call,
Yeah,
Peter. I mean,
at 60 cent.
for
Yeah.
for the bold move in having the conviction from a research team nowadays is getting rare. Yeah, I must say it
Yeah.
has translated to a lot of participation, and yeah, a lot of our retail clients are also was really excited with it.
Thank you. Thank you. Yeah.
Mm. Yeah, so on the solar side, there's a follow-up question on just from Sue. I mean, we started with Sue, right? There's what can you just comment on Samadan and Pekat? Uh, it's a very broad comment, right, Sue? But yeah, if
Yeah.
you do not
Sure.
have
Sure.
much clarity, then probably we can
Yeah.
pass it
Yeah.
on for the next
Y-
one.
Yeah, I think generally Sulawesi and Samaden, what I can, since it's a general question, what we believe the main difference is that between Sulawesi and Samaden is the proportion of EPCC versus the proportion that is concession based, meaning they
Mm,
themselves are in that concession, right? So I think for that reason, that is the most significant difference. But we believe currently what is the difference maker is still the share in EPCC, which SolarVest has currently about, if I'm not mistaken, 30% of market share. So for that
mm,
reason, and EPCC is the one that we are most optimistic right now, and the pie could be growing, and therefore that's the one that we recommend. Of course, at this juncture, Samaden, as you can see, also won their, I believe, their winner of LSS5. So they are also getting more into the concession asset space at this juncture. Pekat, we personally do not cover, so I will refrain from commenting too much at this point. But I certainly thank you for the suggestion. Yeah.
okay, so
Yeah.
probably we jump to the next question from Michael I. In Kanaga's view, what do you think that which sector is likely outperform in the first half, and then
Mm.
second half, and the thought process behind that? This is an interesting one actually. A bit
Yeah.
more on timing, right?
Yeah, yeah. First half
Mm.
and second half. No, that's a very fair question.
Yeah.
Yeah, that's a very fair question. I think for the first half and second half, if we are really going to look at the sectors, per se, and then we come back to the sectors. We think that in the near term, those that have potential to surprise will come in the form of plantation companies. We think that the plantation companies, at this juncture, the market is probably looking at a scenario whereby fund managers themselves are also scratching their heads because plantation prices in terms of CPO continue to hover 4.6, 4.7. No, previously they ended the year at about 5,000. So it indicates a market whereby the supply tightness is still very evident. And using that as a so-called anchor, we think that there is potential for the earnings in the fourth quarter to surprise. And usually for these planters, when they have got a so-called windfall sort of earnings, typically they are not ungenerous in giving out more dividends, right? So basically, that's the angle we have here. If the
Mm,
earnings is good, this could likely encourage more of the investors to come into the fold, so you get some capital gain in the near term, and you might have a second pickup from dividends. So that's one area that we quite like. Of course, when we look at the potential for upside surprise on the upstream, because upstream prices are high right now. In terms of sensitivity, it goes by Sime Darby SD Guthrie. That's the one that is most sensitive. Then we have KLK, and then for the smaller name, we like Hap Seng Plantation. So every 5% change in CPO assumptions versus the street will be about 8 to 9% to earnings. So you can see that if CPO just stays 5 to 10% higher, the street earnings should be close to 15 to 20% higher than what it is today. So I think that's where we call it a potential for surprise, if that's fair, Adrian, right?
Yep,
So
yep.
this is one area that we are looking at quite closely. Compared to some houses, I think there is starting to some investors or some research houses are starting to say that there could be a little bit more risk in the Gulf environment. We are not completely dismissing it. Of course, the Chinese players are often smart enough to want to expand in other countries, such as likes of Vietnam. I think more recently also new countries have started to be in their radar where they can expand. But at this very juncture, we think that even if those expansion plans will come to fruition, it will take time, right? So you cannot immediately just expand into a new country at this juncture, and therefore the earnings that is going to come over the next few quarters will continue to be very robust. We
Mm.
believe that the sensitivity is quite high in every US dollar difference, and currently the glove players are selling at about 19 to 20 US dollars in terms of ASP. Every single $1 difference can have a material about close to 30% earnings impact because it's all flow through to bottom line. Therefore, as long as there is, I think in January, volumes will likely be, I would say, flattish in our most recent conversation with Top Glove and the report we published. But ASPs are going to probably prop up the earnings. So for that reason, we don't see any factors for us to underweight this. But we
Yep.
think that those that really make sense to hold are Hata and Kosan, given that they have about close to 40 to 50% exposure to US compared to Top Glove, which is currently trying to increase that number. So,
Okay.
so,
Yep.
so, in short, hope that answer Michael's question. Planters and glass are the one that we look more for the first half. For the second half, then that is where I believe we will start to be looking at the likes of, oil and gas, because that is when we believe that at least for the the next preceding quarter, right? Meaning to say up to February results season, some of the earnings, let's say for example, Petronas Chemicals, which is one of our top market picks, may still experience some weakness in its PIC, which is the Pengerang Integrated Complex. So once the earnings are being so-called kitchen sunk in the upcoming results, investors or even fund managers may even interpret a worse result to be a positive, So it could be those
Mm.
type of environment whereby the worst is over and people will buy in again. So somewhere between March and towards second half of the year, we expect the PCAM side could likely do pretty well. Polyolefin prices should pick up, and of course, China is a big consumer of PE or polyethylene. We think that for those reasons, if China does even do a bit of stimulus, potentially after Trump comes in and the tariffs war get a bit clear, we think this is also one of the names that could do well in the second half. If you don't like something more on this chemical sort of space, that's where I would like to talk about utilities. In that we like Tenaga, but at the same time we also think that YTL Power that is going to unveil their AI data center
Mm.
if there is no delay by right somewhere in the third quarter results, meaning to say their first quarter FY June 2026, they are supposed to deliver AI data center earnings. So those AI data center earnings, if assuming no delays, will likely be the moment investors are looking for when the earnings come up, and those who are invested will likely stay quite well rewarded. We have recently upgraded YTL Power into our market picks. It's done relatively well since close to around 3 ringgit, right? But
Yep.
right now there is a bit of risk, and therefore happy to take any questions on those end as well.
Okay, while we are on oil and gas, Peter, David has a question on the follow-up on where do you expect any downside risk for pet deck and pet gas with a takeover of gas distribution by Petros in Sarawak?
Okay, right. I think specific to the takeover of gas distribution in Sarawak, uh, right now we think that at this moment, obviously nobody really has the dollar value amount, right? In terms
Mm.
of what is the so-called compromise that Petros and also Petronas has to come together and iron out so-called your duties, my responsibilities, and in the future, but one thing is quite clear that Petros is not trying to totally go it alone because they don't have the
Yep.
expertise, right? So they
Yep.
will
Yep.
still need each other. The whole crux of the problem over here is potentially because Petros wants a good deal, but Petronas believes that Petros is not really pulling their weight, right? But they're getting a big share, or in Petronas's eyes, a bigger share of what they are entitled to. So for that reason, we have come to a point this so-called discussions where I think the Prime Minister has also hinted that things are already at a very advanced stage. We
Yep.
certainly need to look out for what are the details of that. At this juncture, we have not come up with a very detailed company by company analysis. We just think that given that the Petros side, which is taking back the distribution of gas for the most important thing here is that they are doing it for local use. So it's only subject to the local use and not for the as previously where Petronas is the aggregator, now
Mm.
that's being taken over by Petros, and we don't think that the capex that is going to be lost by Petronas is going to be very significant. But and for that reason, we don't think that it will have a very significant impact on the oil and gas stocks
Mm.
that we promote right now. Certainly, within the names that was mentioned, Pet Gas and Pet Deck. Between those two, I would say that we are more fans of Pet Deck at this juncture. Of
Mm.
course, Pet Deck is more closer to the consumer side and on the retail side, where we think that previously the issue was that there was too much of an overreaction
Yep.
at that juncture when people were too afraid of the diesel subsidy removal, and subsequently it was shown that that wasn't too much of a impact to the company. Likewise, therefore, with now the subsidy withdrawal likely to happen not earlier than June 2025, that's where we think that this is probably some good timing to be able to accumulate for now. But yeah, so sorry, I don't have a company by company analysis on that taking over by Petros on the local distribution over there.
But I think that's quite a very good sharing that you have actually shared with us. But we are running a bit short of time. Probably we can have until 9:12, 9:10. So let me pick a few more questions. Is like uh, probably we touch on the healthcare side because like from John, what is the new view from research that the government will implement the DRG system in private healthcare and also the
Mm,
recent insurance premium hike on the insurance companies. That
yeah.
is from the Q&A part lah. We can actually take it at one go.
Mm.
Then we follow up with the Gamuda's LRT win today with will it revise the TP, and then we end it with the KLCI performance by Hoda.
Okay.
Yeah.
Okay. Yeah. Okay, so that's a very tricky question in terms of the the DRG, right? The commonly
Yep.
abbreviated DRG. And those who are following the news will know that on the day that the DRG was announced, some of the healthcare stocks actually derated. We think overall, what investors need to perhaps appreciate is also the fact that the DRG is not completely new in that in other countries, it has always been more common to apply it on the public hospitals, right? So to say that we are going to do it in a private space, obviously then it raises question marks to see whether how useful or how sustainable it is. Now for those who need a refresher a bit about the DRG, what happens over here is currently when we go to the hospitals, we are given a itemized bill, right, of every
Yep.
single thing that
Yep.
we are trying to get from the hospital, and the government who is going under DRG is trying to prevent this type of abuse, specifically not overstaying in a certain hospital. That's why it was very important if more so for the public hospitals that people don't
Mm.
just overstay, right? If you overstay, you actually take away the opportunities from others, right? So for that
Yeah.
reason, the currently under the DRG, what is happening is that if I touch wood, if I fall sick in the future and if I go to the hospital, I based on the doctor's examination of my current status, they will put a cap onto what is so-called the total bill that should be under this type of complication rather than
Mm.
itemizing it one by one. So in so doing, what is quite clear to Kenanga is number one, the market is taking a view that this will be net negative. However, we are saying that for what it is, Malaysia hospitals are not subject to a cap. So meaning to say, while
Mm.
the government or the under DRG, the hospitals might say that I under this current, let's say I have a sore throat is 100 ringgit. They never cap this 100 ringgit, right? So it's not a cap, but it is subject to negotiation between the hospitals, and for that reason, there is a bit of an overhang. We do not know whether it will come up much better or far worse, or just being relatively neutral. So for that, we consider that an overhang. However, if we just look at the selection of hospitals play, obviously we have IHH and KPJ, and those
Yep.
who follow hospitals will know that IHH is actually more diversified. In fact, Malaysia is about close to, I think, 10% of their total revenue. And for
Yep.
those reasons, we think that IHH probably is a little bit more insulated, and therefore we still prefer IHH above KPJ at this point in time. Yeah, so that's on the DRG. On the insurance side, we also cover several insurance players. Those that we cover, such as LPI. We also cover Syarikat Takaful. At this juncture, we do not foresee that the insurance specifically, sorry, specifically on healthcare insurance to be a material enough segment to these insurers that it will completely change our outlook or the way we think about
Mm.
them. Certainly, we think that the requirement for that the insurance players will need to, at this moment, based on Bank Negara's transition rules, absorb some of the costs, definitely could have some slight negative impact to the insurers. But this is sort of like a compromise, right? And right now, it looks like it is the insurers that have to bear a little bit more of the burden. And that seems to be our assessment right now. Definitely on Kenanga side, we highlight this risk, but we certainly don't think that our thesis is broken for insurers just because of that.
Mm. That's cool. So
Yeah.
probably the last question before we move
Oh,
on to
sorry.
Isabel.
There was a question on Gamuda, right?
Yep. Will
Adrian.
it revise our TP or is it within our forecast?
Yeah, maybe the easier way for me to answer is to say that at this juncture, our assessment for Gamuda over here, we think that our current target price is 540. That is based on a certain number of assumptions on data center, let's say 3 billion yearly. If we do get to a more bullish scenario of 4 billion yearly, we think that our upside target is about 6. So what we are saying is that we do still see that there is scope for Gamuda to be rate higher. vis-a-vis today's announcement, as far as I understand from my construction analyst, it shouldn't be different from expectations. So I probably have to reserve my comments at this point to
Mm,
say what we can do with the target price, because that is a report that we are still working on. But I can say that, this was an area that we believe had not been very different from what we expected to happen as
yep,
vis-a-vis the Penang LRT at this juncture. Yeah.
yep. Okay. Probably one really last one is like, yeah, probably we can move on also. But you know what, Peter? There's a lot of questions and a lot of interest in all of our session. Probably in the next round, we can also see how we can tackle this going forward because the excitement is real. Um, yeah. So before I move on, I'd like to thank Peter for his time and everyone for their kind questions, and also they're so overwhelming on SEZAC, on Trump, which I believe Peter who have covered it already in the earlier stage of the presentation. Yeah, and also the companies that are looking to be that we are looking to position for the first half. So before I move on to Isabelle, I'd like to thank Peter again. And yes, your feedback is really valuable to us. Please do take a few moments to complete the survey because we are actually very excited to see where we can make more improvements so that we can try to accommodate more uh, for every one of us here to learn more and also timing management and also be able to answer to everyone's question. Yeah. So um thanks again, Peter. Without further ado, probably pass the floor to Isabel.
Thank you, Adrian. Thank you, everyone, for that.
Thank you so much. It has been really, really great.
Yeah, thank you so much, Peter. Greetings, everybody. Happy New Year. Hello, Adrian.
恭喜发财.
Hi, Gongsi Fachai. You know how it is in Malaysia. The second they stop playing Christmas music, it is Chinese New Year music immediately, right?
Yep,
I love that. Well, I'll just get straight to it. My
yep,
session, it covers warrants really quickly, and as you've heard from Peter's session, he covered a bunch of really great calls. And what I want to show you right now is the warrants that are related to his calls. Can you see my
yep,
slides? All right, great. So you can see SolarVest CK, Tenaga C2Q, Inari CSV. You can screenshot this, or by tomorrow, we'll share it on our Naga Warrants Telegram, our Naga Warrants by Kenanga. That's our Telegram. MBank C48, Gamuda C2R, MBMR C4, and of course PChem C1D. So if you're interested, Peter's session is more of the Big Mac and warrants are the French fries. Warrants are the salty accompaniment to the main dish.
I was always thought it's Sunday.
I think the trick is, as we all know, it's the French fries in the sundae, right?
Yep.
Highlight of the meal. Don't get me hungry. All right, so have a look at this. We're looking right now at a few things. So for those of you who haven't seen me before, can I just have a really quick one? If it's the first time you're seeing me and listening to us, press 1 in the chat. If you've seen us a few times, press 2. If you've seen us for the third time or you've heard about warrants, press 3 so I know how fast to go. A quick disclaimer. All right, I see some ones, some twos from Jamie Ngo, Solly Wong 3, Jack Lee 1, Singguan. Hey, hi. 3-1, Atira 1, Feng. All right. I see some ones, I see some twos. Hello, Zulkifli. That's me. You don't need to know about me too much. As long as you learn about warrants, I'm happy. And the awards we've won. So, like I mentioned earlier, we have